There are moments in financial history when the most important events don't arrive with headlines, they arrive with dates. January 1st, 2026 is one of those dates. On the surface, it looks ordinary. A policy change here, a rule update there. But underneath, something far more dangerous is forming. A convergence of physical scarcity, geopolitical policy, and financial leverage is creating what may be the most extreme imbalance the silver market has ever seen. And at the center of it all sits one institution, JPMorgan. According to this analysis, China OIS January 1st export controls may function as a kill switch, one that traps JPMorgan in a $22 billion short position it cannot escape, and exposes the paper silver market as a fractional reserve system on the brink of failure. This is not a story about speculation, it's a story about math. Part 1. The January 1st Convergence. January 1st, 2026 is not important because of one event. It's important because two critical supply constraints activate at the same time. Each would be disruptive on its own. Together, they may be catastrophic. China's export licensing regime. Starting January 1st, China will require explicit government approval for every ounce of silver exported. China controls an estimated 60-70% of the world's tradable silver supply, not just mining, but refining, processing, and export flows. This policy doesn't technically ban silver exports, but in practice, it does something almost as powerful. It turns silver into a strategic resource, subject to discretionary approval. That means no guaranteed volumes, no predictable timelines, no emergency sourcing. For global markets, China is no longer a tap. It's a valve, and Beijing controls it. The LBMA Cyrillic ban. At the same time, the London Bullion Market Association is set to enforce new compliance rules on silver bars. Under these rules, bars with Cyrillic markings, commonly associated with Russian refiners, may lose good delivery status. Estimates suggest this could instantly remove 200 to 300 million ounces of silver from the pool of acceptable global inventory. The silver doesn't disappear, but in bullion markets, non-compliant silver might as well not exist. If it can't be delivered against contracts, it cannot relieve shortages. Part 2. Why JPMorgan is caught. This is where JPMorgan enters the story. For over a decade, JPMorgan has been widely regarded as the dominant force in silver derivatives, holding massive short positions across futures, swaps, and unallocated accounts. This structure worked for years because physical demand was muted, inventories were sufficient, delivery requests were rare, but that changed in 2025, from paper to physical. In late 2025, delivery pressure intensified. According to market sources, JPMorgan allegedly faced a situation where paper obligations could no longer be rolled or settled quietly. The solution? An emergency lease of 128 million ounces of physical silver, roughly 4,000 metric tons, from China's ICBC bank. This was not paper, it was real metal. And the lease carries one non-negotiable condition. It must be returned in physical form in early January 2026. That is the trap. Part 3. The impossible timing. Consider the timing. JPMorgan must return 128 million ounces of silver. Exactly when? China restricts exports. LBMA disqualifies massive inventory pools. Western vaults are already drained. There is no excess supply waiting on the sidelines. There is no emergency reserve. The bank must source metal at the exact moment the world's largest supplier shuts the door. Part 4. The fractional reserve reality. To understand why this is so dangerous, you must understand how the silver market actually works. The silver futures market is a fractional reserve system. Only about 5% of contracts ever demand physical delivery. That assumption is the foundation of the entire system. It allows banks to sell enormous quantities of paper silver backed by a tiny amount of real metal. Right now, the ratio of paper claims to deliverable COMEX silver is estimated at 17:1. That means 17 ounces promised for every 1 ounce available. As long as delivery demand stays at 5%, the system survives. But if delivery demand rises to just 6%, the math breaks instantly. Demand exceeds supply. There is no buffer. Part 5. Inventory depletion. The clock is visible. This isn't theoretical, it's measurable. At current delivery rates, COMEX's registered silver inventory is projected to be exhausted by March 2026. If panic accelerates after January 1st, that timeline compresses dramatically. In a true delivery rush, inventories could be drained in weeks or even days, and there is no supply rescue coming. Part 6. Why supply cannot respond. Silver supply is uniquely constrained. Most silver is mined as a byproduct of copper, lead, and zinc mining. That means higher silver prices do not quickly increase supply. New mines take a decade or more capital. Investment has been weak for years. At the same time, demand is exploding. Solar panels, electric vehicles, AI data centers, electronics. This demand is inelastic. Factories do not stop because silver prices rise. Production lines shut down without it. Part 7. The mathematics of JPMorgan's collapse risk. Put the numbers together. JPMorgan allegedly owes 128 million ounces. COMEX registered inventories hover near that same number. China controls most new supply and restricts it. LBMA removes hundreds of millions of ounces from eligibility. Industrial users cannot stop buying. This is not a short squeeze in the traditional sense. This is a physical default trap. If JPMorgan tries to buy silver, prices must rise violently, premiums explode, the paper market loses control. If JPMorgan cannot buy silver, the lease risks default, confidence in physical backing collapses. Paper contracts are exposed as under-collateralized. Either outcome breaks the system. Part 8. Why this is not 1980. Critics often compare this to the Hunt brothers in 1980. That comparison misses the point. The Hunts were a single levered entity, dependent on borrowed money, vulnerable to rule changes. This time is different. The pressure now comes from Chinese state policy, cannot be bankrupted, industrial users with billion-dollar production lines, sovereign entities securing strategic metals, retail investors demanding physical delivery. You cannot margin call a government. You cannot bankrupt an industry. You cannot shut down global manufacturing quietly. Part 9. Price scenarios, driven by history and math. So what actually happens to price in a market like this? Not opinions, not hype, not headlines. History gives us the framework. Math sets the boundaries. When physical commodities enter shortage, price does not move gradually. It reprices in steps, sometimes violently, until demand is rationed. Silver is no exception. Conservative scenario. 100, 100, 120. The conservative case assumes order, not chaos. In this scenario, markets remain functional. Confidence erodes slowly, regulators intervene early. Delivery stress is managed through cash settlement and rule changes. Under those conditions, silver merely realigns with historical norms. If gold trades near $4,000 and silver reverts toward even a moderately conservative gold-silver ratio, the math points directly to the $100, $120 range. This is not extreme, it is not unprecedented. It is a normalization scenario. It assumes no sustained panic, limited industrial hoarding, managed stress within futures markets. In other words, this is the best case outcome for the system. A moderate scenario, $180 to $220. The moderate scenario assumes stress is not contained. Here, delivery failures increase. Industrial users stop relying on just-in-time supply. Physical premiums persist rather than compress. This is where history becomes instructive. Silver's 1980 peak, when adjusted for inflation, sits roughly in the $180 to $220 range. But the context today is fundamentally different. In 1980, silver was primarily monetary and speculative. Industrial demand was far smaller. Above-ground inventories were larger. Today, silver is embedded in energy infrastructure. EV production, solar expansion, and electronics require it continuously. Substitution is limited and slow. This scenario assumes silver is no longer just an asset. It is a bottleneck, and bottlenecks don't price gently. Vertical spike. Scenario, $280, $400, $100. This is the scenario markets fear and pretend cannot happen. It requires one condition: panic among real buyers. Not traders, not speculators, but industrial users and sovereign entities. If manufacturers realize that, supply cannot be guaranteed. Futures contracts may settle in cash, inventory cannot be sourced at any price. They don't hedge. They secure supply at all costs. At that point, silver stops trading like a metal and starts behaving like palladium did in 2022, when supply vanished and price discovery went vertical. Palladium didn't double, it tripled. Not because of speculation, but because production lines were at risk. Silver is far more critical and far more underpriced. In that scenario, price does not move in ranges, it gaps. Part 10. Why this is a kill switch. China's January 1st policy matters for one reason: it removes time. Markets depend on delay, roll contracts forward, defer delivery, cash settle quietly, change the rules later. Export controls eliminate those options. When supply is restricted at the source, arbitrage breaks down. You cannot source metal elsewhere. You cannot wait it out. You cannot manufacture inventory. The system must reconcile now, not later. That is why this is not a catalyst. It is a kill switch. Catalysts move markets. Kill switches end games. Part 11. What this means for investors. This moment is not about trading setups. It is about positioning before repricing. In structural breaks, price matters less than how you're exposed. Physical silver removes counterparty risk entirely. Unhedged silver miners offer asymmetric leverage to price. Paper instruments increasingly depend on trust and settlement. When systems fracture, the question is not, how much did it go up? It is, who got paid and who didn't? That distinction defines outcomes. Part 12. Disclaimer and responsibility. It must be stated clearly, the alleged JPMorgan ICBC silver lease has not been confirmed by official sources. This analysis is built from industry reporting, public inventory data, regulatory timing, observable market stress. This content is provided for educational and informational purposes only. It is not financial advice, but markets do not reveal truth through press releases. They reveal it through pressure. Conclusion: the kill switch. For decades, silver has been priced as if supply were endless. It is not. January 1st, 2026 may be the moment when paper claims collide with physical limits, confidence is tested, and silver discovers its real price. This is not speculation. It is a mathematical trap built on public data. The countdown is visible, the supply is finite, the leverage is extreme. The only remaining question is not if the system breaks, but how high the price must go before it does.